Every single headline you read about the silver crash was a lie. Not a misunderstanding, not a different interpretation. A lie. They told you the bubble popped. They told you the bull market ended. They told you silver was overvalued and finally came back to reality. I read those headlines too. I watched CNBC anchors smirk as they said silver investors learned their lesson. I saw Bloomberg publish articles with titles designed to make you feel stupid for ever believing in silver. And for 3 days, I almost believed them. Then I did something those journalists never did. I pulled the actual data. And what I found made me realize that the mainstream financial media either does not understand how silver markets work, or they understand perfectly and chose to lie anyway. Either way, you deserve the truth. And that is exactly what I am going to give you in the next 30 minutes. Welcome to Finance Currency. This is the channel where we expose what mainstream media hides. If you are tired of being fed narratives designed to benefit institutions instead of individuals, you are in the right place. Hit subscribe right now because I release deep research like this every single week. And drop the phrase headlines lied in the comments so I know this community sees through the propaganda. Let me start by acknowledging something important. If you watched your portfolio drop 50% in a matter of days, you felt something. Fear, confusion, maybe even shame. You questioned yourself. You wondered if you were wrong all along. You thought about selling everything just to make the pain stop. I know that feeling. I have lived that feeling. And I want you to know that everything you felt was valid, but the conclusions you drew from those feelings were based on lies. Here's the first lie they told you. Silver crashed because investors finally realized it was overvalued. This is complete nonsense. And I can prove it with a single data point that every journalist had access to, but none of them reported. When silver was at its peak, the London silver lease rate was essentially zero. Calm, normal. No stress in the physical market whatsoever. Right now, after the crash, after silver dropped from $121 to $64, the lease rate is sitting at 4.5%. Read that again. Before the crash, zero. After the crash, 4.5%. If silver crashed because it was overvalued and nobody wanted it anymore, why is the cost of borrowing physical silver higher now than it was at the peak? Why are professionals in London paying historically extreme rates just to get their hands on actual metal? That single data point destroys the entire mainstream narrative, and they never mentioned it, not once. Here's the second lie they told you. The smart money sold and the dumb money got caught holding the bag. This is the exact opposite of what happened. And again, I can prove it with data. The COMEX open interest data shows that approximately 39,000 futures contracts were closed during the crash. 39,000 positions that no longer exist. And who held those positions? Long-term investors who decided silver reached fair value? No. The data shows these were leveraged speculators, traders controlling massive positions with as little as 5% of their own money and 95% borrowed. When margin requirements increased, they were forced to sell. They did not choose to sell. They were liquidated. The weak hands did not sell to the smart money. The over-leveraged gamblers got wiped out while the strong hands held. That is the exact opposite of what the headlines implied. Here's the third lie they told you. The silver bull market is over. This might be the most damaging lie of all because it is designed to shake you out of your position right before the next leg higher. Let me show you why this is demonstrably false. During bull markets, price crashes happen. They always happen. They are part of the process. Silver crashed over 30% in 1974 before going on to hit $50 in 1980. It crashed over 30% multiple times during the 2008 to 2011 run before hitting 50 again. The question is never whether a crash will happen. The question is what the crash represents. Does it represent fundamental deterioration, or does it represent a technical leverage flush? And every single piece of data I have collected says this crash was technical, mechanical, and had absolutely nothing to do with the actual supply and demand picture for physical silver. Here is what mainstream media does not want you to understand. Silver has two markets. There is the paper market where futures contracts trade with massive leverage on exchanges like COMEX, and there is the physical market where actual metal changes hands between miners, refiners, industrial users, and investors. These two markets are connected, but they are not the same thing. When the paper market crashes because of forced liquidation, it can temporarily drag the price down even when the physical market is screaming that there is not enough metal. And that is exactly what happened. The paper market crashed. The physical market got tighter. The disconnect between these two markets is the single most important thing you need to understand about what just happened. And the financial media either cannot explain it or will not explain it. Either way, they failed you. I spent the last 10 days pulling data from sources that most retail investors have never looked at. COMEX open interest reports, Shanghai Futures Exchange inventory data, London lease rate curves, backwardation metrics. And when you see all of this data together in one place, the lie becomes obvious. The truth becomes undeniable. And you will never trust a mainstream silver headline again. Let me show you exactly what I found. Before I show you the data, I need to make sure you understand the mechanism that caused this crash. Because if you do not understand leverage and margin calls, none of the evidence will make sense. And this is something that took me an embarrassingly long time to fully grasp, even though I have been studying markets for years. On the COMEX, which is the primary silver futures exchange in the United States, traders do not have to put up the full value of their position. They put up a small percentage called margin. During the silver rally, some traders were controlling their entire position with just 5% of their own capital. That means for every dollar they put up, they were controlling $20 worth of silver. 19-to-1 leverage. Let me put that in terms anyone can understand. Imagine you have $10,000. With 19-to-1 leverage, you're controlling $190,000 worth of silver. If silver goes up 5%, your position gains $9,500. You almost doubled your money on a 5% move. Sounds incredible, right? Now watch what happens when silver goes down 5%. Your position loses $9,500. Your original $10,000 is almost completely gone. And here is the critical part. You do not get to sit there and hope for a recovery. The exchange sends you a margin call. You either deposit more money immediately or they close your position for you. They sell you out whether you want to sell or not. This is called forced liquidation, and it is completely mechanical. There is no human making a judgment call about whether silver is still a good investment. There is just a computer calculating whether you have enough margin to hold your position. If you do not, you are out. Now here is where it gets really dangerous. When one group of traders gets margin called and forced to sell, their selling pushes the price down. When the price goes down, other traders who had slightly more cushion suddenly find themselves in margin call territory. They get liquidated. Their selling pushes the price down further, which triggers margin calls on the next group, which causes more selling, which pushes the price down even more. It is a cascade, a domino effect, a mechanical waterfall of forced selling that has absolutely nothing to do with whether silver is actually worth less than it was yesterday. Think about it like this. Imagine a packed nightclub where someone yells that there is a fire. Everyone rushes toward the exit at the same time. They are trampling each other. People are getting hurt. From outside, it looks like the building is collapsing. But there is no fire. The building is fine. The drinks are still being served. It was just a false alarm that created a stampede. The stampede was real. The damage was real. But the underlying cause, the fire, never existed. That is exactly what happened to silver. The crash was the stampede. The stampede was real, but the fire, some fundamental problem with silver, never existed. It was pure leverage and margin calls, creating a mechanical cascade that fed on itself until there was no one left to liquidate, and the exchanges made it worse. Not through manipulation, but through standard risk management procedures. When volatility increases, exchanges raise margin requirements. This is designed to protect the system from systemic risk. But during a rally, raising margins has a specific effect. It forces the most leveraged traders to either deposit more capital or reduce their positions. During the silver rally, margins went from 5% to 8%. Some traders could not come up with the extra capital. They were forced to sell. Then margins went to 11%, more forced selling, then 15%, then 18%. Each increase created a new wave of liquidations. Each wave of liquidations pushed the price lower. And each price drop triggered more margin calls on traders who thought they had enough cushion. I want you to visualize this. Picture a staircase going down. Each step is a margin increase, and on each step, there is a group of traders getting thrown off the building, 5% to 8%. First group gone, 8% to 11%. Second group gone, 11 to 15. Third group gone, 15 to 18. Fourth group gone. By the time margins reached 18%, almost every single trader who had been irresponsibly leveraged was completely wiped out. Their positions no longer exist. They are not sitting there waiting to sell more. They already sold everything. The cascade exhausted itself because there was no one left to liquidate. And this is the part the headlines never explained. When you see a 50% crash, your brain assumes that means 50% of the demand disappeared. It does not mean that at all. It means leveraged speculators got blown out in a margin cascade. The actual fundamental demand for silver, the industrial users who need it for solar panels, the mints who need it for coins, the investors who are accumulating physical metal, none of that changed. The only thing that changed was the forced selling from over-leveraged gamblers who should have never been using 19-to-1 leverage in the first place. Here is what the headlines should have said. Silver crashes 50% as margin cascade wipes out over-leveraged speculators, while physical demand remains unchanged and inventories continue declining. But that does not generate clicks. That does not create fear. That does not serve the interests of institutions who want retail investors to sell at the bottom. So instead they said silver bubble pops as investors flee, and millions of people believed them. Now let me show you the data that proves everything I just explained. I am not asking you to take my word for it. I want you to see the evidence and draw your own conclusions. And more importantly, I want you to verify this data yourself. When you see these numbers on a screen that is not mine, it will hit differently. The The first chart I want you to see is the COMEX Silver Futures Open Interest. Open interest is simply the total number of active futures contracts in the market. It tells you how many positions are currently open. When silver was peaking near its highs, open interest reached approximately 176,000 contracts. That was maximum participation, maximum speculation, maximum leverage in the system. After the crash, open interest dropped to approximately 137,000 contracts. That means roughly 39,000 contracts were closed during the decline, 39,000 positions that no longer exist. Now ask yourself a question. Who closes their position during a 50% crash? Long-term bulls who believe in silver? No. They hold or they buy more. The people who close during a crash are the people who are forced to close. They are the ones who got margin called. They are the ones who were gambling with borrowed money and the music stopped. The open interest collapse is the fingerprint of a leverage flush. It is mathematical proof that the crash was driven by forced liquidation, not voluntary selling by informed investors. But I did not stop there. I wanted to know if this was just an American phenomenon or if the same thing happened globally. So I pulled the open interest data from the Shanghai Futures Exchange in China. And the chart shows the exact same pattern, the exact same spike in open interest during the rally, the exact same collapse in open interest during the crash. 2 continents, 2 exchanges, the same mechanical event. This was not one exchange having technical problems. This was a global flush of leverage speculators happening simultaneously around the world. When I saw both charts side by side, I knew with absolute certainty that the headlines were lying. This was not investors deciding silver was overvalued. This was a coordinated margin cascade triggered by volatility and leverage, not fundamentals. Now let me show you the physical market data, and this is where the lie becomes impossible to defend. If silver crashed because demand dried up, the physical market should show signs of easing. There should be more metal available. Borrowing costs should be falling. The urgency should be decreasing. The exact opposite is happening. I pulled the London silver lease rate data. Let me explain what this is because it is critical and almost nobody talks about it. London is the largest trading hub in the world for physical silver. Professional participants there constantly lend silver to each other. One party needs to deliver metal next week but does not have it yet. Another party has metal sitting in a vault that will not be needed for a month. They lend it. The rate they charge for this loan is the lease rate. In a normal healthy market with plenty of silver available, the 1-month lease rate hovers around 0. Sometimes slightly positive, sometimes slightly negative. Anything above 1% is considered stress. Do you want to know what the lease rate is right now? 4.5%. I went back through years of data. In 2023 and 2024, the lease rate was flat at 0. Completely calm, no stress. Now it is at 4.5%. That is not a yellow flag. That is a 5-alarm fire. It is the physical silver market screaming at the top of its lungs that there is not enough metal to go around. While the paper price was crashing and every headline was telling you silver is finished, the professionals in London who actually handle physical metal were paying historically extreme rates just to borrow it for 30 days. Do you understand the disconnect? The paper price says silver is crashing and nobody wants it. The physical market says we are so desperate for metal that we will pay almost any price to borrow it. One of these is lying, and I can tell you with complete confidence that it is not the professionals who actually need the metal. But there is another data point that is even more damning. It is called backwardation. And this is something that should almost never happen in a storable commodity like silver. In a normal market, if you agree to buy silver for delivery 1 year from now, the price is slightly higher than today's price. This makes sense. Storing silver for a year costs money. Insurance, storage fees, opportunity cost. That cost gets built into the forward price. This is called contango, and it means everything is fine. When this relationship flips, when the price for silver delivered today becomes higher than the price for silver delivered in a year, that is called backwardation. And it is deeply abnormal. It means buyers are so desperate for physical metal right now that they are willing to pay a premium just to get it immediately instead of waiting. Right now, silver is not just in backwardation, it is in extreme backwardation, the deepest level I can find in modern data. The professionals are literally saying, take my money now because I cannot wait for a delivery next year. I need the metal today. This is the physical market refusing to confirm the paper price crash, and the headlines completely ignored it. There is one more piece of evidence I need to show you, and this is the one that ties everything together. I have been tracking the inventory data at COMEX in New York and at the Shanghai Futures Exchange in China for weeks. And what these charts show makes the mainstream narrative completely collapse. The COMEX silver inventory chart shows a consistent staircase pattern going downward. Every week, less metal. Every month, less metal. The registered inventory, which is the metal actually available for delivery, has dropped to its lowest level in years. It is down dramatically from where it was just 6 months ago. The metal is leaving the vaults, and it is not coming back. No reversal, no stabilization, just a steady, relentless decline. The Shanghai inventory chart shows the same thing. From a peak of over 1 million units, the number has collapsed by more than 70%. The vaults are draining at an extraordinary rate, and this drain has not stopped. If anything, it has intensified during the crash. Now, I want you to think about this very carefully. If silver just crashed 50% because the bull market is over and nobody wants it anymore, why are inventories still falling? If demand has dried up, why is there less metal in the vaults today than there was before the crash? If the trade is dead, why are lease rates at levels we have never seen before? If silver is overvalued and unwanted, why is the physical market in the most extreme backwardation in modern history? The answer is obvious. The crash was not about demand. The crash was about leverage. And once the leverage was flushed out, the underlying reality remained exactly the same as it was before. Except now the price is lower and the physical market is even tighter. Let me reconstruct exactly what happened step by step because the sequence matters. Step 1. Silver rallied from approximately $37 to $121 over several months. During that rally, speculators piled into COMEX futures with massive leverage. Some were using as little as 5% of their own capital. Open interest surged to 176,000 contracts. The market was loaded with over-leveraged bets. Step 2. As the price moved faster, volatility increased. When volatility increases, exchanges raise margin requirements. This is not manipulation. This is a standard mechanical process designed to reduce systemic risk. Margins went from 5% to 8%, then 11%, then 15%, then 18%. Step 3. Each margin increase forced the most leveraged traders to either deposit more capital or close their positions. Most of them could not deposit more because they were already maxed out. So they sold. Their selling pushed the price down. The lower price triggered margin calls on other traders who had slightly more cushion. They sold too. And the cascade began. Step 4. In a matter of days, silver went from $121 to $64. 39,000 futures contracts were liquidated. The reckless gamblers were flushed out of the market. Not because silver became worthless, not because demand disappeared, not because the bull market ended, but because they were gambling with borrowed money and the music stopped. Step 5. And this is where we are right now. The speculators are gone. Open interest is at its lowest level in months. The market is now held by participants with real capital, real conviction, and real reasons to own silver. The weak hands have been replaced by strong hands, and every single indicator in the physical market is telling you that the actual metal is more scarce and more in demand than it was before the crash. The price went down, the physical tightness went up. Think about what that means. It is like a coiled spring. The further you push it down while the underlying pressure builds, the more violent the snapback when it releases. And there is something about commodity markets that most people who come from stock market investing do not understand. In equities, when prices crash, demand usually dries up. People get scared. They stop buying. They wait for a bottom. Commodities work differently. In commodities, lower prices often increase demand rather than decrease it. Industrial buyers who need silver for solar panels or electronics see lower prices as an opportunity to secure supply at a discount. Mints that need silver for coins increase their orders. Physical investors who have been waiting for a pullback finally start buying. That is exactly what the inventory data confirms. The price crashed and the metal kept leaving the vaults. The physical buyers treated the crash as a sale, and they are still buying. The people who actually use silver and understand silver responded to the crash by buying more, not less. Only the paper speculators were selling. And they were not selling because they wanted to. They were selling because they had no choice. This is the truth that every headline hid from you. Now I want to speak directly to 3 groups of people watching this video, because I know this community is made up of people in different situations, and each group needs to hear something different. If you sold during the crash, I understand. I truly do. Watching a 50% decline is psychologically devastating. Your brain screams at you to stop the pain. Every instinct tells you to get out, and the headlines were confirming your worst fears. You made a decision based on the information you had. But I want you to look at the lease rate chart, look at the backwardation data, look at the inventory decline that continued right through the crash, and ask yourself one question. Does a market that is this tight, this stressed, this desperate for physical metal look like a market that is finished going up? Or does it look like a market where the paper price temporarily disconnected from physical reality? If you held through the crash, the data says you made the right call. Not because the price recovered immediately, but because the structural picture underneath the price never broke. Inventories kept falling. Lease rates kept climbing. Backwardation kept deepening. The foundation of this bull market is not the number on your screen. It is the physical tightness underneath it, and that tightness has only gotten more extreme since the crash. The speculators who created the volatility are gone. The strong hands remain, and the stage is now set for the next move. If you have been watching from the sidelines waiting for an entry, this is the data you need to make your decision. I am not going to tell you what to do with your money, but I will tell you what the numbers say. The leverage that created the waterfall has been cleaned out. 39,000 contracts worth of speculative positions no longer exist. The people still in this market are the ones with real capital and real conviction. And the physical market has never been this tight in the entire history of this bull cycle. Here's what I expect to happen next, based on everything the data is showing me. And I want to be very clear that these are my observations based on evidence, not guarantees. The area around $60 to $70 has a high probability of becoming the new structural floor for silver. The mechanism that pushed prices sharply lower, which was forced liquidation of leveraged futures positions, has largely been exhausted. There are simply not enough over-leveraged speculators left to create another cascade of that magnitude. At the same time, the forces that push prices higher, physical demand exceeding available supply, declining inventories, extreme backwardation, record lease rates, all remain firmly in place and are actually stronger now than they were at the peak. I also need to be honest about risks, because I never want to present only one side of a trade. I hold silver. I have skin in this game. And there are scenarios where this thesis could be challenged. If lease rates in London fall back toward zero, that would signal the physical tightness is easing. If extreme backwardation normalizes and the market returns to contango, that would suggest the urgency for immediate physical delivery has faded. If inventories at COMEX and Shanghai begin to rise meaningfully, that would indicate new supply is entering the system. I am watching all of these indicators every single week, and if the data changes, my view will change with it. But right now, today, none of those conditions are present. Lease rates remain extreme. Backwardation is deep. Inventories continue to fall. The data has not changed. Only the price changed. And the price changed because of leverage, not fundamentals. Here is something I want you to do right now. Verify this yourself. Google Silver Lease Rate London. Look at the number. If it is still above 4%, you are looking at a market in extreme physical stress. Google Silver Backwardation 2026. See what comes up. These are not opinion pieces. These are market rates set by actual transactions between professional participants who collectively trade billions of dollars worth of silver every month. They cannot be faked. They cannot be manipulated by a YouTube video. They are the raw, unfiltered voice of the physical silver market. And that voice is saying one thing very clearly. There is not enough silver. 5 years from now, people will look back at this crash and study it as a textbook example of how leveraged paper markets can temporarily disconnect from physical reality. They will point to the lease rate chart and the inventory data, and they will say it was obvious in hindsight. The crash was mechanical, not fundamental. The strong hands who held through it were rewarded. And the real signal was never the price falling. The real signal was the physical market refusing to confirm the decline. So the next time you see a headline that says the silver bubble popped or the bull market ended, remember what you learned today. Ask yourself what the open interest data shows. Ask what is happening to lease rates. Ask whether inventories are rising or falling. Ask whether the physical market confirms what the paper price is doing. Because when you ask those questions, you will see through the lies every single time. This is finance currency. I will keep tracking every data point, every lease rate update, every inventory report, and I will be here to walk you through what they mean as this story continues to unfold. If this video opened your eyes to how financial media lies, drop the word truth in the comments. Send this to one person who sold during the crash and is now questioning that decision. They need to see this data before they make their next move. The headlines lied, the data told the truth, and now you know the difference. I will see you in the next one.